Brand new ETF for 0 days to expiration options hitting the market today. The Defiance NASDAQ 100 Enhanced Options Income ETF, aiming to grant investors access to what has become a very popular strategy in recent times. Mike Coe joins us with a closer look at this fund. Mike.
Yeah, so the QQQY ETF basically tries to take advantage of the ability to sell near-dated options. Specifically, they are looking at selling short-dated options on the NASDAQ 100 index options. And what this strategy is going to be doing is selling options that expire anywhere from 1 day to as far as a week out, and collect about 25 basis points worth of premium every day by selling puts. Now, if you're selling puts, obviously you're hoping that the market goes up, but this is a strategy that's relatively path dependent because you are selling volatility. So the best thing for this strategy is if the market just basically treks sideways or moves mildly higher, because if it moves sharply lower, you're going to have some losses that you're going to need to make up. And of course, it's taking advantage of the fact that there's been a big uptick in short-dated options trading as a result of these zero DTE options.
Catch, Mike.
What's that?
What's the catch, Mike?
Well, you know, the catch, as always, if you are selling put options, you're selling a form of insurance on the market. So if volatility spikes, you're going to have some risk there. There's something else, too, which I think is kind of important to think about, which is when you sell very short-dated options, you're subject to what we call path dependency, which is how the market behaves from 1 day to the next. If I sell an option that expires in 1 month and the market ends up at or above that strike, I'm going to make my money. However, if I start selling at-the-money options every day, I can actually dig myself a hole that I need to then dig my way back out of. So even if the market ends up higher, if it took a really bumpy ride to get there, this might not work out.
What's your take, Dan, on a product like this?
It sounds like an accident waiting to happen. I mean, so you introduce these in a very low vol period. We have a VIX that's, just below 13 here. Mike's talking about taking a quarter of a point by selling at the money puts. If there's some sort of event, right, and there's a number of these sorts of funds that are doing these sorts of things, and it's not just ETFs, right? There's a lot of people employing these sorts of strategies. And, we haven't really been able to put our finger on what these 0 days to expiration, what they've meant. I think a lot of people smarter than us, probably Mike Coe is definitely smarter than me, they said there's been vol dampening, but if there's ever a reason for volatility to come back into the market, I don't know how these things are going to perform.
Well, the expression is picking up nickels in front of a steamroller. Mm-hmm. I mean, the risk reward on it, I don't think makes a lot of sense. I get that short dated options, so not just single day in these OTs, but 5 days or less, or half the option volume of the markets these days, and that makes sense to me, especially given event risk and people that are trading and really a lot of traders don't want to go home with any exposure every night, and they flatten it out, so that makes sense. But again, collecting premium and when you have a chance to really have downsized losses, not trades I want to be part of.
You're not getting paid enough to take that, in my opinion. The market is not paying you enough to take type of risk that you're putting on, and you probably don't even realize that you have.